We will begin today's event by presenting the corporate video of our company, Ashutosh Financial Services Private Limited, an introductory video of today's speaker, Mr. Dakshesh Kothari.
"60 years back, late Mr. Dinesh Kothari started a firm in the name of Messrs. Kothari and Company to provide tax and allied laws advisory services. Later in the year 2001, the activities of the firm got expanded into a corporate entity in the form of Ashutosh Financial Services Private Limited. Over these years, the company has emerged as a prominent player in the field of finance and taxation. The company operates with a quality management system certification of ISO 9001:2015 and is now a complete financial services solutions enterprise. Ashutosh Financial Services Private Limited is presently serving through its 4 different services, namely Ashutosh Investment Services, Ashutosh Insurance Services, Ashutosh NRI Services, Kothari and Company. Ashutosh Investment Services, which is in the activity of connecting people with investment opportunities for Indian markets. Mutual funds for investing in equity, debt and hybrid. Portfolio management services for investing into equity shares. Alternative investment funds for listed and unlisted equity shares. Direct investment in shares of unlisted companies. Advisory stock portfolios for investing in curated portfolios of equity shares. Investing in bonds, that is tax-free bonds, taxable bonds and capital gain bonds. Investing in fixed deposits of top-rated corporates. And investing in precious metals through sovereign gold bonds. For investing in global markets through direct investment in shares of foreign companies and ETFs, and precious metals through ETFs. Ashutosh Insurance Services, providing insurance solutions for life insurance for life risk coverage, health insurance, mediclaim and personal accident, insurance of assets for all types of risks, insurance for liabilities, retirement and pension planning needs, and investment through insurance for guaranteed returns and ULIPs. Ashutosh NRI Services is a one-stop solution for NRIs to address the needs of investments in mutual funds, PMS, AIF, unlisted stocks, foreign equities and advisory stock portfolios, insurance for life risk, health, assets and liabilities, retirement planning and investment through life insurance, complete planning and compliance for Indian income tax, advisory under FEMA and RBI regulations, and complete support for compliance related to foreign tax laws in respect of Indian incomes and assets. Kothari and Company works as a solution house for complete income tax planning and compliance, and estate planning for advisory related to inheritance laws and preparation of wills. Company is a unique setup which is truly a one-stop solution for all the financial and taxation needs of the client. The company enjoys a state-of-the-art infrastructure facility having its office in the middle of Rajkot city, spread across 4,000 square feet area consisting of separate setup for each division. The company has a fine mix of personnel from financial and legal background like chartered accountants, lawyers, certified financial planner and management graduates to form a dedicated team of skilled and qualified staff. The team works under the dynamic leadership of Mr. Dakshesh Kothari, who is the MD and CEO and the other directors of the company. All the divisions and departments manage their operations with high-tech versatile softwares, and the entire IT infrastructure is connected with integrated file server for seamless exchange of data with security and regular data backup facility. The company has a fully equipped conference room with projection and video conferencing facilities, which makes dissemination of knowledge, information, and interaction convenient. The company has its regional office at Ahmedabad, which is the emerging metropolitan city of Gujarat, to facilitate the clients. The company website www.ashutoshfinserv.com and mobile application Ashutosh Finserv gives an overview of the happenings in the world of finance and also a useful client user interface. We operate multiple investment management softwares for managing our clients' investments, having interface with our website and mobile app. With the help of our website reporting software and app, our clients can carry out complete paperless investment transactions and can have access to their investment portfolio on real-time basis. We regularly update our client with latest happenings from the world of finance and taxation through digital mode of interactions using YouTube videos, WhatsApp broadcasting, and sharing the updates on social media, that is Facebook, Instagram, and LinkedIn. The company has been conducting presentation on analysis of the union budget since last 16 years, organizing series of presentations for non-resident Indians on aspects of taxation, regulations, and investments since last 4 years. And the company is also arranging presentations for various sectors of economy and society by covering topics of vital importance related to finance, taxation, and estate planning. The company serves to more than 3,500 satisfied clients spread across the world and is actively maintaining business relations with many clients and groups for more than 60 years. Ashutosh Financial Services Private Limited is growing as a complete financial solutions enterprise with its presence felt not only in India but also globally. Mr. Dakshesh Kothari is a tax and financial consultant and the Managing Director and CEO of Ashutosh Financial Services Private Limited, which is an ISO 9001-2015 certified company with prominent presence in the field of financial services. He specializes in the fields of income tax, FEMA, trust laws, estate planning, and foreign tax compliances. On the financial front, he specializes in investment services and insurance services. He advises companies, trusts, high net worth individuals, and non-resident Indians across the globe on financial and tax and allied laws related matters. He is a trustee of various charitable trusts. He has been involved with a number of social service projects of Rotary Club and is a Paul Harris Fellow of Rotary International. He has been presenting analysis on the union budget since last 16 years. He has been delivering series of presentations on taxation, regulations, and investment aspects for non-resident Indians since last 4 years. He has also been addressing doctors, businessmen, industrialists, taxation consultants, chartered accountants, company secretaries, NRI and postgraduate students of diverse branches on subjects relating to finance, taxation, and estate planning to make our society financially literate. His articles on financial subjects are regularly published in renowned newspapers like the Economic Times, Mint, etc., and also in magazines like Dalal Street. His interview was aired on ET Now as a mutual fund industry expert in the program named Swatantra, which is one of the most acclaimed investor education initiative of our country. He has also addressed a program dedicated to NRI on a leading Gujarati TV channel in Ahmedabad. He is a 360-degree versatile personality in the fields of taxation and finance which makes him a unique and a truly a one-stop solution provider for a wide range of financial and tax-related matters.
Hello, everybody. It gives me pleasure in talking to you on a subject which is like, straight away benefits for NRIs under Indian taxation and other regulations. All these years, I have been delivering so many presentations on the various regulations, the provisions of law. But today, what we are going to do is that we are absolutely targeting ourselves on what are the benefits that the NRI can look forward to within the Indian taxation and the other regulations which affect the non-resident Indians. The first and foremost thing which I would like to bring forward is the taxation benefits under double taxation avoidance agreements. While interacting with so many NRIs across the globe, I have found out that information in respect of these double taxation avoidance agreements, as they are called in short form as DTAA, is quite limited. And there are so many benefits which one can derive out of it. Basically, in order to understand the utility and the basic purpose of a DTAA, which is, as I said and I repeat, a double taxation avoidance agreement, is that there are so many advantages when a non-resident is doing any kind of investment, any kind of generation of income related activity in some other jurisdiction. In order to understand this, we should understand the basics of taxation of any non-resident. When any non-resident across the globe, this is not just limited to the Indian taxation, but this is the basic cardinal rule how taxation happens to persons who are deriving income across countries, across jurisdictions. So the first rule is a residence rule. Under the residence rule, any person who is a resident or who is domiciled in a particular country or a particular jurisdiction is supposed to pay taxes on the global income, that is, the income which that person derives from the country where he is domiciled or he is resident, and also the countries outside the country where he is a resident, but he is deriving income from there. So he is supposed to aggregate his total income. He is supposed to aggregate his total income when he is filing his tax returns under the residence rule. Now, the another rule is the source rule. So, under the source rule, the countries from which the person derives the income or he is able to generate the income, those countries facilitate the respective person, and those incomes are taxed in the countries from where these incomes are sourced, and that is the source rule. So now, in order to illustrate this, to explain this, to make it very clear, I will give a small example. Say somebody is a tax resident of USA. Now, because he is a tax resident of USA and he is domiciled in USA, he will be taxed in respect of his US income, obviously, because he is resident and is domiciled. But because he is a resident of that jurisdiction, under the residence rule, he has also to pay taxes in respect of incomes which are sourced from outside of US, maybe India, maybe the Middle East, maybe UK. Now, under the source rule, all those respective countries from where those incomes are sourced, say India would say that these incomes are sourced from our country. So we will tax those incomes which you have derived from our country. So they will tax that very income under the source rule. Now, Middle East, which is normally there is no income tax, say a UAE. UAE doesn't have any income tax. So UAE under the source rule will not tax that income. UK will tax the income of that person who is resident in USA under the source rule as per the UK taxation. So now what happens is that when that tax resident of USA is filing his returns or filing his taxes in USA, he is supposed to aggregate all the incomes of USA where he is a resident and also his incomes in India, UAE and UK, and thereafter file his tax returns. So now what happens is that he is paying taxes on the aggregated income in the USA. At the same time, he has also been taxed under the source rule in those respective countries from which he has derived the income. So the fear that would come up in our mind is, then I am subjected, or that person is subjected to double taxation. In order to see that double taxation does not happen, different jurisdictions, different countries, they enter into agreement with each other to see that double taxation does not happen in respect of incomes of persons of both these countries. At the same time, that will lead to fostering economic trade and investment between those countries. When it comes to India, India has presently signed double taxation avoidance agreements with more than 89 countries. So all the major economies, all the major jurisdictions of the world, they are covered under the DTAA signed with India. So under that, what would happen is, in order to see that one income, one single income does not get taxed twice, there are reliefs provided. And the primary relief that is provided is that either there is given an exemption of whatever are the income taxed under the source rule in a country where it will not be taxed in the country where it is subjected to taxation under the residence rule, or there is a tax credit which is given in respect of the taxes which have been paid under the source rule. So once again, I will illustrate and explain. So coming to the very example which I had given about that US tax resident. So now when that US tax resident is filing his tax returns in USA, he would be subjected to taxation on the entire global income, which is the US income, as also the incomes from India, UAE and UK. Now, under the exemption method, if there is an exemption method type of a DTAA agreed or entered into between two countries, then the income which has been taxed in a particular country under the source rule, say there is an exemption method between UK and USA, then the income from UK will not be taxed while filing tax returns in USA. So there won't be any double taxation, because once the tax has already been collected in respect of the income by UK. Now, under the tax credit method, when those incomes are subjected to tax in USA, what all taxes have been paid in India or UAE or in UK, the credit of those taxes would be available to that person while filing the US tax return. So the effect will be that one income will not be taxed twice, and that is the primary relief that everybody, every non-resident should seek while filing the tax returns. So there is a fear with so many tax residents that what I will do is that I will file my tax returns in the country where I am a resident. I will not disclose my income under the source rule from the countries where I am sourcing the income. The reason being that I will be taxed twice. But under DTAA, there is a clear-cut relief which is available. So no incomes are taxed doubly. This is a very important point which all the non-residents should take care of. Then what is the extent of credit that is available? The extent of credit that is available is to the extent of proportionate taxation that is happening under the residence rule. If there is a rate of tax which is more under the source rule, and under the residence rule the rate of tax is less, then whatever is the rate of tax under the residence rule, which is say a lower rate, only relief to that extent would be available. Refund of taxes under the source rule will not be available. Then beyond this double taxation avoidance agreement related prima facie relief that incomes would not be taxed twice, there are so many advantages in terms of lower rates of tax, tax concessions, which are available under DTAA. And the principle is that if there is a DTAA existing between two countries and there is a local law, say the Indian Income Tax Act and the DTAA, then whichever provisions are beneficial can be accepted or adopted by the non-resident while paying taxes. So to explain, if a US tax resident is taxed or is governed under DTAA, and there are certain provisions under the Indian Income Tax Act which are not so beneficial, but DTAA provisions are beneficial, then he can fall back on the DTAA provisions and seek to be governed by those provisions rather than the Indian Income Tax Act. I will illustrate this. The rates of taxation on incomes in India in respect of dividends received by non-residents is 20% plus surcharge. And the interest that is received on any deposits is taxed at a slab rate. Now, when it is taxed at a slab rate, it might so happen that if my income is beyond 10 lakhs of rupees, then I'll be taxed at 30%. So a non-resident having a NRO account interest or any deposit interest could be taxed at 30% tax rate. And his dividends could be taxed at 20% plus surcharge. But under the DTAA, with different jurisdictions which I have illustrated, say the USA. In case of USA, the dividends are taxed at 25% and interest is taxed at 15%. So what I can do is that in respect of dividend, I can pay taxes on the basis of the Indian tax law, and in respect of the interest, I can pay taxes under the DTAA. So for dividends, I will pay 20% plus surcharge because the provisions of the Indian Income Tax Act are beneficial, while as when I'm paying tax under the DTAA on interest income, 15% is a beneficial rate of tax. So in the slide, I have given the details of different rates of tax under the DTAA for different jurisdictions. And you can see that those are really beneficial or concessional rates of tax. And a non-resident can definitely take advantage of it and benefit out of it. You can see that the rates of dividends and interest, which is the major income for our non-residents, are quite low vis-a-vis the rates which are the prescribed rates under the Indian Income Tax Act. The another advantage is a tax concession which is available under the several DTAAs. So when you are governed by a particular DTAA, you need to look into it that what is the kind of tax advantage or tax concession that is available. To illustrate, when you look at the DTAA of UAE and several other African countries, the provision or the articles of the DTAA state that certain types of capital gains are liable to taxation, not all the capital gains. So effectively what happens is that in respect of gains on mutual funds, whether equity or debt-based mutual funds, they cannot be taxed in respect of non-residents of all these jurisdictions. It might sound a little shocking, but this is a fact that UAE tax residents and several African countries tax residents can claim a relief under the DTAA, and they are not liable to any capital gains on sale of any mutual funds. So these kinds of concessions need to be looked into when you are governed by a particular DTAA. The another concession which is available is that whenever you are paying taxes under the rates prescribed under the DTAA, then that is the final rate of tax on which you need to pay your taxes, or rather that is the rate. When it comes to Indian taxation, the rate is the prescribed rate, but on that there is an addition of surcharge and cess. But when you elect to pay taxes under the DTAA prescribed rate, you are subjected only to just one rate and no surcharges and cess. I have laid down several decisions of various judicial forums which has approved this view. Then, in order to claim this benefits under the DTAA, what should I be doing? I need to obtain a tax residency certificate from the country where I am claiming my tax residency, and that TRC is an annual certificate which I need to file before the Indian income tax authorities, along with a specified form 10F and a declaration of tax residency. This form needs to be filed before the Indian income tax authorities and also before the tax deductor. So the moment I give my tax residency certificate to a bank or to somebody who is distributing or giving income to me, then it is obligatory on part of that particular payer that they are supposed to deduct my tax only whatever is the prescribed rate and which could be a beneficial rate under the DTAA. So DTAA offers so many advantages which needs to be taken care of, and the benefits of which should flow to the non-residents. Now, coming to a further aspect of DTAA, DTAA is not just limited to those tax rates, that double taxation related relief and tax concessions and everything, but it is much more. It is a long document. It is a long agreement which takes care of so many things which could be some problem areas for the tax residents of both these jurisdictions. The common issue which comes up for discussion before us at several times is that there are so many Indians who have maybe a green card, or there are so many Indians who stay in USA. I'm just naming a particular country, for instance, because we have got a long-standing relationship with USA, where so many of our friends, colleagues, relatives, they travel, they stay back, and so many of the relatives are in the US. So what happens is that in USA, if in order for somebody to get qualified as a US tax person, is a US tax resident, either that person is a US citizen, or if he is an alien, right? He is a he is a citizen of some other country, but he stays in the US for a substantial period of time, or he has a green card, which they call as a substantial presence test or a green card test, then they are deemed to be tax residents of USA. So under the green card test, the moment you have a green card, no matter where you live, you visit USA, maybe in a particular year, you did not visit USA at all, or under the substantial presence test, you are in the USA in the current year just for at least 31 days and 183 days beyond in the last 3 years, then you are adjudged or you are a US tax resident. So the common difficulty that happens is that somebody is a tax resident of India because he did not go outside of India at all. But the very thing which made him a US tax resident was that he is holding a green card, or he was in the USA under the substantial presence test for a certain period of time, which is say more than 31 days. And as I said, those number of days, and he overshoot that limit. So there, the difficulty which comes up is that that person becomes a tax resident of more than one country. So when you become a tax resident of more than one country, all those principles which I was talking of, that under the residence rule, your global income is supposed to be taxed in the country you are a tax resident. Now, I am a tax resident of both the jurisdictions. Then how to clear this mess? So under the DTAA between India and the US, there are tiebreaker rules which have been laid. Under the tiebreaker rule, the moment somebody qualifies for a particular kind of tiebreaker, then it is adjudged that that person is a tax resident of a particular country. So if somebody is holding a green card and somebody has, is living in India, so under the present law in India, he is in India for more than 182 days, so he is an Indian tax resident. At the same time, as I said, he is a green card holder, so he becomes a US tax resident. Now we will apply the tiebreaker rule. So the tiebreaker rule says that there are certain tests which have been laid down. So the first test is place of permanent home. Only if it is not determinable, then center of vital interest. If that is determined, then we need not go further on. So the place of permanent home. So in the instance which I was just putting forward to, I am just holding a green card. I don't have any place of permanent home outside of India. So under the first test, I will become an Indian tax resident despite the fact that I am holding a green card. If I am holding a permanent home in both the countries, say I have a place of residence in India and I am holding a place of residence in US as well, then I need to go to the next test, which says that if center of vital interest cannot be determined, then we'll go to the another thing, which is habitual abode. So the first test is place of permanent home. The second test is center of vital interest. Then the third test is habitual abode. But the moment at least one of them is done, it is settled, we need not go any further. So in most of the cases, the moment you go to first, second, third level of test, it becomes clear as to which country somebody would become a tax resident of. This confusion is with so many of the non-residents, and they really don't know as to how to deal with this aspect in a clear-cut manner and select, or rather determine, the place of their tax residency. So the moment somebody becomes a tax resident under the tiebreaker rule, then the global income of that person would be taxed in the country where that person becomes a tax resident. And the moment that thing gets settled, the incomes from other jurisdictions becomes governed under the source rule. And because it gets covered under the source rule, then that double taxation avoidance agreement works in a seamless manner where double taxation does not happen, and there is a clarity where the global income is supposed to be taxed and where the source-based income is supposed to be taxed. When it comes to the income tax part, then this DTAA works. But when there are laws related to taxation of gifts or taxation related to inheritance related receipts, then this DTAA as such does not work. So then those local laws would work. But the major area of concern with so many of the non-residents is the levy of income tax. And if that thing is settled, then a lot of things are put at rest. And if in case under the source rule, if some income is taxed, and if there is an exemption method which is prevalent between both these countries, then those incomes would get completely exempted and would not be taxed in the country of residence. But when it comes to India and the US, the exemption method is not the one which is a part of the DTAA. The foreign tax credit method is we'll get a credit of the taxes that have been paid in India while filing our US tax returns, or vice versa, depending upon where that person becomes a tax resident. Now, we have laid down what all formalities that somebody needs to do when somebody elects to be a tax resident of India and a non-resident of USA. So the moment under the tiebreaker rule, that part is settled, that this person is going to be a tax resident of India and not of USA. We have laid down that these are the formalities which are supposed to be carried out in India and in the US when this kind of a situation arises, and we should take care and be particular about complying with all these formalities. Now, when it comes to, next slide. So when somebody elects to be a tax resident of USA, then these are the formalities which I have laid down on the slide are supposed to be followed by that respective tax resident. As I said, and I repeat, these formalities should be followed just by looking at the DTAA and under the tiebreaker rule that I will be a tax resident of a particular country. I will not go into any formalities or any filings. That's not a good idea. These are reliefs which are available under the DTAA. So in order to claim the reliefs under the DTAA, one should carry out these formalities, and these are quite simple formalities which are all can be handled electronically, and they need to be complied with. Now we'll go to the next aspect of the beneficial provisions to avoid excess payment of taxes on sale of assets in India. So let's first look at what are the tax related provisions or the deduction of tax, TDS related provisions in India when any income is paid to a non-resident Indian. The moment any income is paid to a non-resident, under the Income Tax Act, Section 195 of the Income Tax Act comes into play. Now, under Section 195, any person who is a payer to a non-resident, is supposed to deduct tax at the prescribed rate on, mark my words, on any sum that is paid. So any sum, whatever name called, the moment it is paid, there are prescribed rates for it and taxes have to be deducted on those sums. Obviously, there are certain incomes which are exempted for the non-residents in the time when they receive. So all those incomes which are exempted for the non-resident and they are not chargeable to tax, there is no deduction of tax that is supposed to be made in respect of incomes which are not chargeable to tax. Now, what happens is that the rates prescribed are the rates of TDS, which are flat rates. My tax liability under the Income Tax Act might be different. So, if on the sum of money which is paid to me, there is a prescribed rate of tax and which the payer is supposed to deduct, then there could be a scenario where there could be an excess deduction which would happen when these payments are made and the non-resident receives this. So there are certain beneficial provisions which have been laid down under the Indian Income Tax Act, being Section 195 subclause 2, which says that whosoever is the payer can approach the income tax department and get the sum determined on which taxes are supposed to be deducted. So the sum to be determined. So I am paying somebody, say 50 lakhs of rupees, but the amount on which I am supposed to deduct the tax might be only 15 lakhs being the income part of it and not the entire sum of 50 lakhs. Then under Section 195 subclause 2, the payer can approach the income tax department and seek a direction from the income tax department in this regard. Then the next relief which is available is the relief under Section 195 subclause 3. Under the subclause 3, a payee, the recipient, if he feels that my incomes are not liable to any taxes as such, then he can approach the income tax department stating that there should be nil TDS, nil withholding tax on these incomes. And the third kind, and which is the most important one, the kind of relief or the beneficial provision is that the payee, the recipient, can under Section 197 approach the income tax department stating that I be issued a certificate of lower tax rate or a nil TDS rate in respect of the incomes which I am receiving. So to illustrate, say in case of a transaction of a capital gains, say there is a sale of a immovable asset. Now, if we look at the way the Section 195, which is the TDS section, which says any sums which are paid, then if the consideration on sale of an asset is say 50 lakhs of rupees, then the TDS is supposed to be made on that entire 50 lakhs. Now, the fact is that out of that consideration, sale value of 50 lakhs, only 15 lakhs is the capital gain. Then what I can do is that the recipient, the payee, can approach the income tax department stating that only 15 lakhs is the taxable income and TDS or the withholding tax in respect of only this 15 lakhs need to be deducted while I am receiving this payment. For this, the payee needs to approach the income tax department, and when I state that has to approach the income tax department, There is no physical approach that somebody has to make. All these applications are absolutely online. The tracking, the response, and the explanations and the receipt of certificate of lower tax deduction everything is absolutely online. I have laid down a couple of decisions which, according to us, settle the principle that if we do not obtain this lower tax deduction certificate, TDS is supposed to be made on the entire sale consideration. So Section 197 gives a lot of relief, and that beneficial provision all non-residents should take advantage of. Just to make a tabular explanation, that when an immovable property is sold, entire sale consideration tax needs to be deducted, or a lower tax deduction certificate under Section 197 or 195 subclause 2 needs to be obtained. The deductor has to be the property, the deductor has to be the person who is selling the property. In case of equity shares, the entire sale consideration has to be subjected to capital gains if the broker is not does not have an information about the date of purchase and the cost of purchase of the shares. But if he has got the details, then he need to deduct tax, short term or long term, as the case may be, on only the capital gain component. And the same principle holds true for mutual funds. Mutual fund asset management companies do have all the information, and so they never deduct tax on the entire sale consideration, because they know the date of purchase, the cost of purchase, and they can make an appropriate rate or appropriate amount of deduction only on the profit value or the gain value. Then the next part of this presentation, we would like to put forward which all incomes and receipts which are completely exempted from income tax in India. When it comes to different kinds of incomes, NRI account interest may be a term deposit or a savings bank account. It's completely tax-free. If somebody is holding a public provident fund account and then he moves outside of India and becomes a non-resident, he can continue with that PPF account till the account gets matured and even makes deposits into it. So in respect of the interest on that PPF account, the interest is tax-free. Agricultural income, there is no tax in India. And next, the most important thing, agricultural land. If agricultural land is situated beyond an aerial distance of a locality which is of the populations which I have stated, if it is beyond that, then they are not subjected to any capital gains, howsoever big that capital gain or that gain might be. So if in case, if there is a city or a town which is having a population about 10 lakhs, and the land which I am selling, which is an agricultural land on which agricultural operations were carried out, agricultural incomes were disclosed, if that land is beyond 8 kilometers, then they are not subjected to any taxation in India, because they are classified as if they are not a capital asset at all. Hence, there is effectively no tax over those gains which occur in respect of sale of these lands. Then any share in profits of a partnership firm, they are completely tax-free. In case of insurance policies where the sum assured is 10 times the premium amount, any maturity proceeds are tax-free. Any death claim received in India in respect of any insurance policy is completely tax-free. There are concessional rate of taxes on dividends and on dividends from companies as their shares and mutual funds as well. It is a 20% tax in respect of both of them. When it comes to resident Indians, if they are taxed at slab rates. So if somebody is having an income in excess of 10 lakhs of rupees, effectively they pay 30% plus surcharge, plus cess kind of a tax, while as a non-resident has to pay the rate of tax, which is just 20%, which has been prescribed in the respective provision, which I have stated in the slide. Then, in respect of any capital gains, there are certain exemptions which are available. So, if there is a capital gain on sale of any land or building, then to the extent of 50 lakhs of capital gain, they can be invested into capital gain bonds. Then, if a residential house is sold and invested into another residential house subject to certain conditions, under section 54, exemption is available. If any assets, any capital asset is sold, and if the consideration, the sale consideration is invested in any residential house subject to, as I said, certain conditions under section 54, that is also exempt. When anybody receives any amount to the extent of 50,000 rupees, they are completely tax-free, which could be in the nature of a gift or anything. Under section 56(2), they are completely tax-free. And even if they are much more than 50,000 rupees, but they are received from certain specified relatives as defined under the Income Tax Act, then they are completely tax-free. The relationships I have mentioned, or if there are amounts which are received on the occasion of marriage or amounts received by way of will or inheritance, they are completely tax-free. So, if in India, if somebody receives any amount by way of will or by way of inheritance with no upper cap, that entire amount is completely tax-free. So, these are the provisions where the entire income would be completely tax-free. Now, we'll go to that part of the presentations where are certain special tax regimes which are available to for the taxation of non-resident Indians, and there are foreign currency related fluctuation reliefs which are available to non-residents. So under the special tax regime for non-residents in respect of taxation, which has been provided under the Chapter 12A of the Income Tax Act, this special regime is available for specified assets, and that too those specified assets which are purchased out of convertible foreign exchange. So what are specified assets? Specified assets we have defined in the slide, which are shares of Indian companies, debentures or deposits of public limited Indian companies, and government securities. And as I said, and I repeat, that they have to be purchased out of convertible foreign exchange. And any incomes, which is the investment income from these specified assets, will be taxed at a concessional rate of 20%, and long-term capital gain would be taxed in respect of these assets at a concessional rate of 10%. This is also the one which is right now displayed on the slide, is an important provision which quite only a few of the non-residents really take advantage of. When any of these specified assets are sold, say shares in Indian companies, or maybe shares in Indian listed or unlisted companies for that matter, and if they are invested in new specified assets, right? So new specified assets are even bank deposits. So if I'm selling my shares, which I had bought out of convertible foreign exchange, and I am depositing these monies in a bank deposit for a period of 3 years, then that entire capital gain becomes tax-free. So this is an important relief which is available under the special tax regime. Then there has been complaints, or there has been a feeling that non-resident Indians, especially of the Western world, they lose out on account of the depreciating Indian rupee. And they feel that whatever are my returns should be taxed only after taking into consideration the losses which I occur on account of this foreign currency fluctuations. So in order to mitigate this hardship in respect of unlisted shares, so if I am investing in a company which is a private company or a limited company, but it's an unlisted company, in respect of those unlisted companies or debentures, the non-residents would get a relief under the foreign currency fluctuation related provisions. So what would happen is that at the time of purchase, whatever was the exchange rate and whatever is the exchange rate at the time of sale, those exchange rate related net capital gain would only be liable to tax under under section 48 after taking into consideration the relief which is available under the foreign currency fluctuation related provisions. Now, this is also a very important pertinent provision, or rather relief, which is available to non-resident Indians. And unfortunately, few of the non-residents take the advantage of it. And so many of the people or non-residents are under the belief that funds from my NRO account, funds from my Indian assets, funds from the assets which I have inherited would remain in India and I would not be able to take them outside of India. So this beneficial provision needs to understand very threadbare. In earlier times, a balance of an NRO account was not repatriable. Only the balance of an NRE account was repatriable. But since 2005, India has come out with a remittance scheme under which presently an amount to the extent of $1 million per person per year can be transferred from an NRO account to a NRE account or from the NRO account to outside of India. The only requirement is that you need to pay the taxes due on it. A simple procedure is supposed to be followed, and those submissions under the Indian Income Tax Act, specified forms needs to be filled. They need to be uploaded, given to the bank, and the banks would, without seeking anybody's approval, they would transfer those monies from the NRO account to the NRE account under the scheme. The moment the conditions which have been laid down under the scheme, which are simple conditions, that appropriate taxes are paid, certificate of chartered accountant, and uploading of the forms on the website, they are done. Those formalities are done. Then those monies which are standing as a balance in the NRO account can be transferred to the NRE account or outside of India. Beyond this $1 million per person per year, which is a limit which is available, if there are genuine cases of hardships, a specific approval can be sought from the Reserve Bank of India, and a larger amount beyond this $1 million is also allowed to be repatriated by the Reserve Bank of India to that respective non-resident. Now, there are so many advantages of converting the NRO funds into NRE money. The moment the NRO funds are converted into NRE money, and if they are just lying in the bank account, the interest on the NRE deposits in India is completely tax-free. Moreover, there will not be any TDS on the interest which is received, because now it is NRE money, it's no more an NRO money, and they become fully repatriable wherever the account holder desires to move at the time when maybe the exchange rate is comfortable or whenever he needs that money. So this is basically a relaxation given to the NRIs. it is not an obligation to the government of India to hold on, this relief. The balance of an NRE account, the government is under a promise to allow the repatriation of funds in respect of the balances of the NRE account. But when it comes to the NRO account, this is a very big relief which is available to non-resident Indians, and they should, in my view, not keep any money in the NRO account for obvious reasons. If it's a taxable income, then why should I keep my money in an NRO account? And I should convert into an NRE account and make deposits or use the money from the NRE account. So this is a relief which every non-resident needs to be very clear of and take the best advantage out of it. Beyond this $1 million relief which is available, as we have discussed in detail, when it comes to residential properties, and if those residential properties were purchased out of the balances of NRE, FCNR account or remittances, then repatriation in respect of 2 such properties is allowed beyond this $1 million limit. So there, this $1 million limit does not apply. Say if I am selling a house worth 10 crores of rupees today, which I had bought maybe 25 years back out of a NRE account balance or a remittance in India, then that entire amount of 10 crores can be repatriated out of India after payment of appropriate taxes. Beyond this, if the amounts which are lying in our NRO account, they are out of current incomes, then those are considered as transactions under the as current account transactions, and they can also be transferred from NRO to NRE or outside India. Obviously, appropriate taxes have to be paid on it. So if I'm receiving any rent or interest or any income from any business or profession, then this $1 million limit, I need not exhaust into it. These are current account transactions, and these transactions are completely repatriable out of whatever are the balances which are accumulated out of these kinds of incomes. Now, the next point which I would like to take, which is a very important point, especially in the times when so many of the non-residents, even when they had desired to come to India, but they have not been able to come to India, the relief which is available very much under the provisions of the law in India, which has always been available, but so many of the non-residents are quite ignorant of it, is that NRIs can execute his or her will in respect of Indian asset while outside India. Even when they are outside India, they can validly execute a will in respect of their Indian assets and bequeath through the will whatever they want to without coming to India, sitting in their respective countries. Now, in order to understand this aspect properly, let us look into that. How does the law of succession apply in India? So in respect of global assets of an NRI, which can be divided into 2 assets out of India and assets in India. In respect of assets out of India, then the transmission or inheritance or succession of these assets would be governed by those respective provisions of those respective foreign countries. But when those assets are in India, they are absolutely governed by the law of inheritance, which is in India. So one has to be very clear that in respect of the Indian assets, the Indian law of succession would operate. When the Indian law of succession operates, there are 2 scenarios which can happen. One, there could be a testamentary succession, or there could be an intestate succession. An intestate succession is a succession where somebody in India dies without executing a valid will. So when that person dies without executing a valid will, then the law of succession, which is prevalent in respect of that particular community, will be applicable on the assets or estate of the said deceased. But under the testamentary succession, when the assets are bequeathed on the basis of a will, it is called testamentary succession. And it is always desired, or it is always desirable, that one goes through the route of testamentary succession rather than intestate succession, because then he can really bequeath the assets the way he really desires. So there, what somebody needs to do is that in respect of the Indian assets, they need to execute a valid will under the provisions of the Indian Succession Act. If there is one global will for foreign and Indian assets, then it is perfectly okay. One can have a composite will in respect of both the assets, but it is always advisable to have a separate will in respect of the Indian assets, because it will lead to a scenario where there is no unnecessary disclosure of foreign assets. Then the will should clearly mention that this is a will in respect of only the Indian assets. Then when somebody is making a will, then he can, or he or she can, make a will in respect of all the Indian assets, or assets which are a few assets, which could be a specific will. Now, what are the essentials of a valid will? That it needs to be in writing. It should be able to clearly identify the testator or the person who is executing the will. Then the details of the assets which are bequeathed, the names of the beneficiaries, the signature of the person who is executing the will, signature of the witnesses with their clear-cut identification. And it is advisable that the will is in English, unless maybe if the testator, the person who is making the will, does not understand English, it is always advisable to have a will in English, so that if that will is supposed to be produced before any authorities in India or abroad, it becomes easy. Then when a will is executed outside of India, it is advisable that it is signed before a notary public. Then for both the witnesses, as I said, that we require 2 witnesses to confirm the will, and in respect of both the witnesses, we should obtain a declaration that that person has been a witness in the will, and a declaration in writing signed before the notary public of the respective witnesses also should be obtained. And at the time of execution of the will, which will take place in India, the executors can come to India and produce before the courts the will and the declaration of the witnesses that they have been witness in respect of the particular will. Public notices would be issued, and thereafter it will be the will be probated by the court, and it will be a conclusive document as far as transmission and succession of asset is concerned. The last part of my presentation, which is a very important part, is that what are the benefits which have been availed to non-residents under the way there have been changes under the Indian Income Tax Department. When it comes to the changes under the way the Indian income tax law has been operating, there have been, as I would say, an absolute change the way things have been working. And the absolute change is that now all filings are e-filings as far as Indian income tax is concerned. All scrutiny of the filings, assessment, appeals are absolutely faceless. And all the transactions which take place in India, financial transactions, they are all mapped with a permanent account number. There is no scope of any personal interaction with any income tax authorities or by any income tax authorities. If we want to meet or they want to meet, it is not possible. There is no scope of any personal interaction. The functioning has undergone a major absolute change, and this reform has gone absolutely unnoticed. This is a landmark change which has happened, and this is a march towards the complaint so many of the non-residents had, that India runs a parallel economy, it is not a compliant economy. But now the way the changes have occurred, it is a complete march towards that. So alongside all these things, what is going to happen is that all the non-resident Indians are going to get, and for that matter, all the taxpayers are going to get an annual information statement. So because all the transactions are now mapped with the permanent account number. So everybody, all the taxpayers will get an annual information statement which will contain all the details of their incomes, expenditures, withdrawal of cash, purchase of shares, mutual funds, real estate, credit card related transactions, investments, everything. And one needs to verify those things and settle that these transactions are my transactions. And if they've got some issues, then they need to inform the income tax authorities through the portal and the system. And while filing their tax returns, have to see that whatever I am filing, I am taking into consideration all the information which is on display under the AIS. And hence, all the NRIs should give their complete information on all their dealings in India to their tax advisors to file the returns in a proper, correct manner. And one should see that the contact details, mobile numbers, email IDs, and everything of all the taxpayers have to be exactly the same, which is in the bank account and which is the one with the income tax authorities. So whenever there is a transfer of funds or a net banking kind of a situation, there doesn't remain a conflict. And this is very important in case of any kind of remittances which are supposed to be made from any account. Otherwise, those things have to be authenticated by one or other means. So now there are so many benefits under the operations of the income tax department. At the same time, one has to be very particular that all their contact details and personal details are clearly updated and mapped from time to time. One thing which we have come to our notice is that certain non-residents or few of non-residents, they mix up their transactions in respect of the first account holder, second account holder, and the third account holder in the same account. So that is not a good idea when it comes to India, because in India, the first account holder is considered as an owner for the banking and taxation purposes, and the second and third holder are merely either or survivor or signing authorities in that respective bank accounts. If one wants to carry out transactions in respect of the various individuals, then they need to open separate banks accounts. And one more advice which the way this entire scenario is building up is that now all the accounts by whatever bank, whatever kind of accounts that you hold in one destination or another, they are all connected with each other because they are all mapped with one single permanent account number. So there is no reason to have multiple bank accounts of the same person. So with the benefits which has come under the faceless operations of the income tax department, we also need to see that we are in sync with the way the income tax department is moving. So our life, the way the thing would operate in terms of compliance on the taxation side, becomes absolutely seamless. Whatever I have been saying are my personal views, and in order to act upon that, one needs to seek specific professional advice in keeping with the facts of that respective individuals. Wherever I have opined on something, we have tried to put forward the references for the opinion which we are forming, and these are my general views on the subject. With those words, I would also request you people to stay connected with us on our website, which gives a lot of information to the non-resident Indians on various subjects, and there is a lot of information, FAQs, and so many things which could be very much useful to the non-residents. And on our social